Hey everybody, super happy to be here once again. And today I have Jerome Busca. Jerome is a great guy with a ton of time. I think 25, right? 25 years of experience in the field of quantitative
That
research,
is
quantitative
that is
development.
correct.
That's a lot. That's a lot. And I expect to have a really great conversation today, talking about you and your experience and whatever you have experienced during your career in the quantitative space. So before we get to go, I would like to ask you, how are you today?
I'm great. Thank you, Afek, and thanks for having me. Yeah, great to be here.
The privilege is mine. The privilege is mine. Now, before we get to go, I would love if you can introduce yourself to the audience. Tell
Sure,
them a little bit more about yourself.
sure. So, my name is Jerome Busca, and I'm a quant trader. I started out in academia. So I was born and raised in France, and did most of my career in the United States. In New York and Chicago. And so I started that as a researcher in mathematics. I was actually part of the government-funded research institute, CNRS, in France, doing um, basically partial differential equations and math applied to physics and all that sort of things, but very and that was in the 90s. So I'm kind of dating myself here, but uh, and very quickly I became interested in finance, and quant finance at the time. I mean, and for the listeners that are old enough to remember that time, um, quant finance in the 90s was really an emerging field, I would say. Now, of course, uh, I'm not talking about, I'm talking more about, alpha, right? Quant trading. Now, if we're talking about the quantitative method in, let's say, asset pricing or, option pricing, all that kind of thing, that's of course, older. But in terms of forecasting markets, let's say, that was brand new, and that was a quite fascinating field. There was, for example, the most successful hedge fund of all times, arguably Renaissance Technology. I believe started in the somewhere. I mean, started
Somewhere
enormous.
around the 90s. Yeah.
Exactly, yeah, in kind of
Hmm.
mid 80s, and started really taking stride in the 90s. So all that made for a sort of fascinating uh, period, and that's why I was, like many, I was drawn toward that uh, towards that field. Um, and so and that's why I took a consulting job in a bank first, doing kind of old-fashioned asset pricing and all that kind of stuff. But very quickly, I decided to go deeper into finance and moved over to the US and had a career over there. So it's a kind of a long introduction, but that's
Yeah, look,
that's sort of my
obviously
background,
you
right?
you have a lot to introduce. That's the fact. Now, before we even dive deep into your work as a quantitative researcher, you have a uh, real rich experience when it comes to quantitative research before the 2008 bubble crash of the 2008 the Lehman Brothers crash just occurred. I don't really know if exposing the name of the fund is allowed, but I think that it would be a fascinating discussion if you would tell us like about your quantitative research in the back in the time before the Lehman Brothers crash.
Sure. Yeah. So effectively, I started out in earnest in 2004, so full 4 years before the Lehman Brothers crash of 2008, at Citadel, and Citadel, the hedge fund, and actually at the time, Citadel Securities didn't even exist. That that came later. So it's the on the hedge fund side of Citadel, and at the time, so from 2004 to 2007. And this was a really, these were the heydays of mortgage-backed securities and, CMO, CDOs, CDO squares, and all, all that kind of thing that eventually blew up in 2008. Um, and I was actually on the mortgage desk at the time, so I was right at the center of the action. You could say. And I was involved in other projects that eventually proved more important to my career, like setting up a CTA, like futures trading desk, pretty much with the portfolio manager as a head quant, and doing other things. But at least for 2 years, my primary function was to be the sort of desk quant or head quant, let's say, on the mortgage desk. So I had a sort of privilege, sort of, very, very close experience to what went wrong on the buy side. Right? Now, of course, you could argue that most of the problems that led to the crisis were actually I wouldn't say orchestrated, but they were definitely triggered by more by the sell side because they were really issuing these tons of bad paper and um, and exotic products and mortgage-backed security-based products and all that kind of thing. So we on the buy side, and I did like 90% of my career on the buy side, we were actually, I want to say we were well aware of, if not an impending crisis, at least of the early warning signs of what would become the Lehman Brothers 2008 crisis. Now, as early as late 2006 and 2007, people on the buy side, I mean, it's not just Citadel, but people on the buy side were openly discussing I mean, quite frankly, the insanity that the mortgage-backed security market has become, um, and um, and what to make of it. I mean, what was going to happen. But
You know,
yeah,
it's very interesting to ask you how was your work back then doing some research among securities because you started with consulting for asset pricing and then you went to Citadel and in Citadel you acted as a quantitative research in the buy side. And my question for you is like how the research part or how everything is actually happened back then because I do think it's very interesting because it's slightly different than what we do today and the tools that we have today and the markets and the amount of data that we have today. So doing research on what data, doing research on what asset, like how do you actually crafted a proper research pipeline in order to provide or yield a sense of I don't know of a breakthrough. Let's call it
sure.
that way.
Sure. Yeah, well, and I can definitely speak to that. And for that it's probably more informative if I speak about my research on the sort of alpha part, so the part of my job where I was I was helping a PM setting up a CTA type font within Citadel, right? So our mandate
Hmm.
was to research any and all data set we wanted, or pretty much to make forecast on the futures market. Um,
On the
and
futures market.
futures, yeah, exactly,
Hmm.
global futures, and
What's
um,
up with futures? Commodities
commodity
or
futures, exactly, energy, metal, base metal, precious metal, some agricultural.
everything was on the buy side.
So yeah, so it was definitely, yeah, we were doing that from the buy side, and it's a kind of trading that so commodity, so-called CTA type trading, so commodity trading advisor, that goes back all the way to the 19th century, right? With people doing charts to predict prices and all that sort of unscientific things, right? And that kind of investing was ripe for disruption, to coin a phrase, and everybody wanted to bring the quant method, right, quantitative method, to the field, right, and do some proper statistical research and so on. So we're not obviously the first, not even the only ones to do that, but definitely Citadel was really good, was at doing that. So to your point, of course, the environment was much different. Data was much harder to acquire. Um, Effectively, you had to. I mean, still to this day, the CME and CBOT, so these are the main
The main
exchange,
exchanges.
exactly, on the futures markets, worldwide, and they still have I would argue, a stronghold. I want to say a stranglehold, really. So they have a sort of lock on on the data for these markets. But at the time, it was even there was nothing else, right? So you had to pay a lot. You had to process the data sets with suboptimal tools, uh, and definitely no Python at the time, right? No, no, of course, no AI, and so that's why we we were lucky in that we could recruit. I'm talking about Citadel here again. We could recruit the best developers, worldwide,
Hmm.
to help us with the infrastructure, and that's, I think, what eventually contributed to the success of this firm, and others. It's the technological edge. So we
So
could, yeah,
you're actually testifying. You're actually saying or coming with the statement that back then investing in infrastructure was extremely helpful, and with the infrastructure that you guys created, it was much better to start doing active research.
yeah,
Now, I would like to ask you, on top of global futures, having proper research on global futures, and obviously everything was expanded and everything is much more established nowadays than what it was back then in '04 till '07. And I want to wonder with you and to have a little bit of a critical session here to tackle about how it's like to do a research on a rolling future contract, and you know that the rolling future contract might not be properly hedged or might not be properly liquidated or might not be properly, I don't know, volatile uh, to to build a sustainable alpha. So the decay is very, very short. And I would like to ask you how it is like to take emerging an emerging future contract or an emerging asset and to build a proper understanding of how to, to increase the duration of the alpha and to delay the decay. Let's call it that way.
yeah, yeah. Okay, so, and look, it is a so so I think your question is mostly about the alpha decay, right? If I understand correctly, right? That's what you have in mind.
Mhm. Yeah.
Alpha decay, right? Okay,
Mhm.
yeah, and that's a great question. Let's see, also a general question. I mean, not just in the futures market, but throughout the quant stack. And it has to do with it has to do with arbitrage, effectively statistical arbitrage, right? Because we know, so the theory tells what I always tell my student whenever I teach, because I've taught in the past sporadically courses in finance, still teach online as well. So I would always tell my student that the efficient market hypothesis it's a good first order approximation. But if you think about how these, I mean, how can these be true, right? And it's not something that the markets are efficient, that are statistical arbitrage free, isn't something that is baked in the market. It has to come from arbitrageurs, right? Uh, because if you just build a market like crypto, for example, maybe we'll talk about crypto at some point. Uh, Starting out, and from the outset, you're going to have a lot of arbitrage opportunities. Actually, okay, that's how all markets start out. And if you look historically, 19th century or even the early 20th century, even at old markets like futures market that have effectively existed forever in one form or another, or the equity market, you will find a lot of arbitrage. Um, so it takes a lot of action from arbitrageurs to make markets efficient, and it's something you can measure. So, for example, and I was lucky enough to live through a period of immense technological progress, and we could really see with our naked eye arbitrages that existed 20 years ago just vanished before our eyes. And the way it does, so for example, to take a very simple example that I think everyone would be familiar with, you could look at, a classic was the lead lag arbitrage between the equity market in New York, right? It was effectively NYSE or NASDAQ,
Mhm.
and the equity futures in Chicago, right? So if you could get your information faster from New York, Chicago, then you could could have an edge, right, an advantage in the market. And that was definitely the case. And it's still the case, but the time scale of that alpha, of that sort of lead lag alpha, went from, something like maybe a second or something 30 years ago down to sub microsecond effectively, or maybe, in two digit number in microseconds, something like that. Um,
Mhm.
so yes, there is alpha decay. The duration of alpha uh, does go down, and we saw that across the board. Um, and and that's why quant trading is an arms race. You have,
Mhm.
but I have to say, um, it is it is true generally for quant trading. That's happening, whatever your style of investing. But it's probably more of an issue the closer to high frequency trading you are. So
That's
yeah.
that's interesting. I would say that when you think about alpha decay, and that's, by the way, it's a topic that I love talking about here in the podcast. I love talking about the duration of how sustainable your alpha should go for, and talking about how to increase its validity among different markets, and or in the market or in the asset class that you're trading, which I think it's an ongoing major challenge to increase the decay of the alpha, because obviously you're not the main participant of the market, and I think that it will be a never ending discussion. And I think that it's more of an art than it is of a mathematical proof, because you cannot control everything. Unfortunately, you cannot control everything. You're not controlling of how much participants you'll have in the market, how much money they will bring to the market, how much inconvenience they will have. And when you actually observe and consider all those changes in the equations, actual boundary of your alpha, I think that it will forces you to think critically of how you can adjust it and modify it, like in proportion to the evolvement of the market. Now, I would like to change the discussion onto a different subject, and I would like to take you in a zone where I like to tackle your experience as a portfolio manager. Now, most of the portfolio optimization nowadays is happening with covariance metrics, and which is like the most straightforward methodology that we have out there. And some of them, by the way, I can say it because I think it's public. It's not me that declares it. I recently reviewed that Man Group are using regularization to optimize your portfolio and to optimize the weights of and the importance of every asset or every strategy in their portfolio. And I would like to ask you, out of your rich experience in portfolio management, how would you look at optimizing your portfolio? How would you look at optimizing the weights of your portfolio? How would you look for inverse correlation movements in the portfolio so you would be able to manage your positions in real time?
Sure. Yeah, that's a great question too. Um, so portfolio optimization, you could say, really dates from the 50s with the work of Markowitz, who formalized the what we know as as the classic Markowitz portfolio, whereby you invert the covariance matrix of the asset, right? And you multiply that matrix with the vector of expected return effectively, right? If I want to say in a few words. Now, this approach is theoretically optimal in the sort of narrow world in which it lives. But very quickly, people realized that it is a limited approach, just because we have a lot of uncertainty in the way correlations are estimated. And that itself being a reflection of the non-stationarity of financial markets. And so anything that assumes stationarity to that extent, so i.e., that you can actually believe in the correlations you're measuring, is doomed to fail effectively. So I mean, there was any. It's not something like very recent that it is. I mean, from the outset, people were well aware of that kind of problem. So there were various fixes that had been that have been suggested since Markowitz's work. So I'm not going to do the whole list. That could be a actually, it could be a lecture in and of itself, right? In a sort of financial group, but just to make it short, um, to make a long story short, I mean, I would say the more interesting approaches to me are approaches that have to do with the with regularization, definitely. That's kind of the earliest fix that was suggested, you know. So you just effectively modify or rectify really the eigenvalues of your covariance matrix to make it more stable. Now there are more kind of modern approaches where you combined your pure Markowitz portfolio with some beliefs, you know, about covariance structure and so on, so that again, tweaks the covariance matrix effectively.
What do you mean? What do you mean some beliefs? Because a belief is not a mathematical expression, and I think that taking a belief and throwing it over your over the Markovian's process might not be a good reflection because I think there is a certain discrepancy here.
No, I mean, I'm really referring to the fact that it's more a Bayesian approach, effectively. So you have a sort of prior about your covariance matrix, let's say, right? And so you think because you've measured it that it's, you know, that way. And then the more data come in, then you kind of evolve your beliefs or really your view of reality. It's a more sort of Bayesian type of approach, right? Yeah, so you have these approaches. They also do some regularization for you. It's just another way of regularizing. There are more modern approaches in which that you know I find interesting personally, especially when you deal with thousands of assets like you know the equity market, because you know right out the gate, if you trade the you know underlying of the S&P 500, you have you know it's a 500 dimensional problem, right? So you're definitely not going to estimate a covariance matrix. So either you go with factors, which is really a dimensionality reduction. Again, that's been well known for decades. There are more recent refinements of it. So you look at factors for the equity market and try to project on on these dimensions. You can also look at, and that's more modern. You can look at the so-called hierarchical covariance,
Mhm.
whereby instead of just looking at the correlations of everything with everything else, you look at a sort of tree of dependencies, right? And you go down effectively the sort of tree that connects the most correlated assets, right?
Mhm.
And you build a hierarchy of things that are. Yeah,
By the way, you have mentioned previously that correlation it's a term that it's hard to measure because you're measuring the correlation. I would say co-movements between a pair of assets. But I would hypothetically say that measuring correlation might not be the rationale of actual measuring if a pair of assets actually move together because correlation measures a top of correlation without like having a proper understanding of the pair of the assets actually move together or not. Like it's they fix me if I'm wrong, by the way. They measure if the assets are moving together upwards or downwards. That's just how it actually reacts. But deeper, if we're deciding to dive much deeper, correlation might be totally mislead the portfolio manager. So
absolutely.
um, that's a very a critical assumption that we would have to think about when we use correlation. And I would like to ask you, Jerome, out of your rich experience, what do you think about what I was just mentioning, and how would you tackle it within your portfolio pairs?
Yeah, so I mean, it's been a recurring issue that's that's plagued effectively quant investing for forever. I mean, as long as it's existed. Now I can say this. And there's actually famous studies like For example, if you and I'm sure a lot of listeners will be familiar with Cliff Asness, the famous hedge fund manager who famously um, is an opponent to any sort of portfolio construction and says you really don't know what you're talking about when talking about correlation. I don't want to hear about it. What I'm going to do is I'm going to equal risk. I'm going to weigh my assets by equal risk. So in other words, the weights are just one over the volatility. So equal risk allocated to each asset, and that's it. And indeed, there are studies that show that this benchmark is really hard to beat, actually. So the
Mhm.
benchmark with no
Yeah, well,
information,
obviously.
exactly, with the sort of simplest sort of strategy for weighting is really hard to beat. Now, having said that, so yeah, correlations are a creature of the Gaussian world, right? So if you believe that returns are normal, then the correlation is well defined and so on and so forth. So these are linear quantities, and of course, this is entirely inappropriate when you apply it naively. Let's just say to real world returns, because we know real world returns are not Gaussian. They don't live in a linear world. There are fat tails, everything we know about the Nassim Taleb, black swan events and all that things. We know that conditional correlations look very different from unconditional and so on and so forth. So there's a lot of literature about these issues, but they all come down to the same sort of conclusion, which is you shouldn't apply uh, instruments from a perfect Gaussian world to a world that is so obviously not. So what can you do? So simplicity is a lot of time best. So definitely equal risk or that sort of thing. You could look, some people have looked at copulas, which really are nonlinear dependencies on co-movements of assets. So you can look at that. They're not a magic wand, but they can do some things for you, especially when you look at fat tails dependencies and things of that order. And it's there's an ongoing debate and a lot of interesting research. Now, if the question is what solutions I prefer in practice, um, I'm going to sort of punt and say I'm lucky enough to work in markets where there are very few assets. So I don't really have that problem. But it's a kind of a cop out, right? But
Mhm.
that's the truth. Because I was an FX trader, foreign exchange trader for many years. In foreign exchange, you have basically five, or you could say seven, but at the most liquid currencies in the world, so-called G7 currencies, right? So your US dollar, Australian, Canadian, Swiss, euro, sterling, yen, and that's it. So your universe is effectively six-dimensional, right? Because it's everything against the dollar. And in a six-dimensional space, you can't go too well. Of course, you can still do stupid things, no doubt, but it's a lot easier to solve that problem of correlation estimation than it is in a 2000 dimensional space if you're trading, let's say, US equity. Okay. So
Mhm.
in that sense, I'm lucky, but I'm well aware of what my colleagues and former colleagues are doing in the space, and also what the research is, and it's definitely an interesting and ongoing debate.
Mhm. Look, I think about what you have just mentioned about like correlation and having a proper estimation for the correlation in order to estimate if you have if you have measured correlation properly. And I think that you retrieve the order correlation from the Gaussian world. And what I was mentioning previously before you started to talk about correlation is that we need to think about correlation not as the top of the iceberg problem, but as much more inherent problem that we would have to tackle. So the measurement will be truthful, and we would be able to actually and accurately understand if we're measuring the rightest understanding. Now let's go over a much more like let's diverge that conversation onto much more economic conversation. And I would like to say that measurement of correlation will be heavily drawn onto financial factors. So not just like deviating a little bit from the mathematical world to the world of economics, and to ask you, Jerome, if you have you ever thought about a possibility that you can find correlation or hidden movements within your portfolio, or within the position, obviously, in your portfolio, that were symbolized by a financial factors or a set of financial factors? And what was it like to detect that occurrence instead of looking at pure mathematical correlation?
Yeah. So the way that would manifest itself is, I would say in two ways. The first would be what I was mentioning about conditional correlations, as opposed to unconditional. So it is true that in some states of the market, so for example, when there is a crisis, it is well known, well established that correlations spike,
Mhm,
and that any sort of risk assets are going to be, and that includes also currencies, and so on, are going to be very highly correlated just because of the market actions. Because people will. So let's say there's a crisis, people are going to dump everything effectively in favor of treasuries. No, let's say. So that automatically creates the spike in correlation and so on. And it's not something you can. So if in your data set, if you don't have a crisis in your data set, you're not going to see it, right? And
mhm,
so you better, so in that sense, either you really look at past crises, which I mean, we've had a few, so we can with good data, so you should definitely look at that. You could also stress test your correlation and imagine what's going on. So it's more of a risk management thing in that sense. But definitely the conditional versus unconditional of the correlation in some states of the market is a factor. Now, there's also another thing going on here, another topic really that's become quite fashionable, and that I know a lot of people are trying to incorporate into their analysis for investment purposes, or just simply for research. It has to do with causality, and
mhm,
causality is so it's a hot topic. Um, and I'm not sort of preaching any favorite type of, but I'm just mentioning that because I think it's interesting. I think, as always, people overdo it as well and market it for other. But anyway, so what does this approach have to tell us in that respect? Well, causality is the search for causal relationships, uh, and I mean the quantitative search, of course, like statistical search for causal relationships, will aim at debunking spurious correlations. And
mhm,
the simplest example of that is the so-called confounding factor. So the return of A the returns of A and B can be highly correlated, even though A and B have nothing to do with each other. But that's because C is actually driving causally, is driving what A is doing and what B is doing. So the action of C, and C could be, whatever. So for example, A could be whatever, maybe stocks, B could be some bonds, C could be the central bank, or, whatever it is. But there's a factor that's driving both of the returns we're looking at. And then a naive look at the data would interpret A and B as highly correlated, whereas in fact it's just the action of C, and when the action of C stops, they stop to be correlated, right?
Mhm.
So in that sense, it's just, I mean, to me, it is just a sort of refinement of this idea of conditional correlation. And now you go deeper and you explain why there are conditional correlations, so conditional on the action of C, right?
Mhm.
So I like these approaches. I think right now, unfortunately, just like everything in our modern world, things get overhyped, and there's a lot of bullshit in the on the topic. But if you sort of filter out the noise, you'll find interesting results about that.
That's very interesting. And I think that the conversation of causality and actually looking for causal relationships, it might be a little more it will cause much more sense to the portfolio manager. Now, I would like to talk about like interpreting this causality, because causality, as you have just mentioned, it's not a thing that aims to be there for 100% of the time, and sometimes causality will change. And how do you detect that changing causality? Because that changing causality will impact your entire point of view over the portfolio.
Yeah, well, um, the so market will have different regimes, and so what? So if you assume you're lucky enough to have identified real causal chains, and that's a big if, right? Because so there are some things we know. For example, we know that central bank if you look at the big things like what the central banks are doing, what the government is doing when it's printing money, right? For example, so yes, for these big sort of factors, you can point out causal chains that are probably real, right? Now, you can also go too far and have, again, spurious causalization. But anyway, let's assume you are so lucky that you identify causal chains. Then the question is, um, then the question is, how are you going to predict what and let's say they're stable in time. So then the question becomes how you predict the behavior of what's upstream in the causal chain, right? So for example, if it's a central bank that's causing, these particular effect you're trying to arb in the fixed income market, to say.
And how do
Then
you build that statistical expression that will enable you to actually predict if a causality or a causal effect have changed in a certain period or have changed dramatically? And by the
yeah,
way,
well,
regime, obviously
yeah,
shifting in market regimes, it's a very difficult thing to make it even interpretable,
yeah,
because regime is, I think it's the definition of a regime is a thing that will change in between people, because it's very much subjective. Not many people, define the same regime as it's supposed to be defined, because everybody has their own differentiation, and has their own idea in approaching the
sure.
market. And because they have different ideas to approach the market, they will define regime differently.
Yeah, definitely. So there's a lot of heterogeneity in the market, right? To speak like an economist. So people will have different interpretation, different beliefs. Having said that, there's also an aggregate behavior that emerges from these various micro behaviors. Now, to your point about changes in causality, I mean, to go back to my example about the central bank. Uh, uh, if people will react to whatever the central bank does and will, of course, try to anticipate what it's doing because we know there's a causal link that's well established in what they're trying to achieve and what and how the market is going to respond. But of course, the net effect of that is to create a sort of feedback loop whereby, and that's kind of neat because that's what the theory tells you should happen, and that's one of the few instances where it does happen, whereby people will have these like will basically look at the Fed models and try to anticipate that decision, right? And they do such a good job that the Fed almost doesn't need to do anything. It will, it will drive the rates in the direction it wants to without even sweating it. So, um, so in that sense, causality changes because the arbitrageurs are effectively front running it. Yeah.
Mhm.
Now, of course, that's just a sort of big picture kind of example. Now there are much more elaborate things that can that people try to detect in the market in a way. Right? Now, I would say uh, I try to have a cautious approach because I'm a practitioner. I'm no longer an academic. I'm no longer. So my goal isn't to publish papers and all that. So even though I'm fascinated by some of the research that's out there, I would say from a practical point of view, I would be very weary about any sort of claim, wary, sorry, about any sort of claim that something is causing some other thing, if it's not a sort of well-known channel. I mean, so
Yeah,
I'm kind of wary about these things. Yeah.
and I think like that process or that funnel of like going from research that have been made from a few researchers in academia and throw it up onto the industry. I think it's a bit complex because of what you have just mentioned. Because people tend to look at the same research in a different from different angles, and not necessarily that the entire research will be applied. But I think that the thinking or the reasoning among the say or among that particular research will be taken, and that's what I do. Like in my field, I like to look at like in academic research and to not retrieve everything, but to retrieve only the questions that have led to that particular findings. So, for example, if I look at a portfolio construction paper, I would take the same questions and would like to modify and adjust them a little bit more to fit onto my case and to ask the same questions as the researchers in academia was tackling in their research. And if the findings in a bit have a sort of equivalency, I would try to go a step further, and that's what I do in my day-to-day research, and how do I think about applying things onto onto my end. Now, I would like to ask you, after thinking about portfolio optimization, which is a thing that we obviously can expand our discussion much more. I would like to talk about portfolio construction because everything starts from how you construct your portfolio. But I would not like to think about or to talk about the construction of an asset. I would like to think about a construction of a strategy. Most people nowadays, most portfolio managers and investment officers think about it in a way to have a multi-strat portfolio in with obviously high diversity of assets that will and the correlation and how do they approach the market will be controlled with their strategy, nor than it will be controlled with the asset. And I think it's a very interesting approach. And I would like to ask you what do you think about that approach and how would you construct a portfolio if you were a portfolio manager again?
Yeah. And we'll probably take the example of equity markets. It's just I guess
The simplest one,
well, exactly. So
the most familiar one, obviously.
exactly most listeners will be more familiar with it. So I agree that a portfolio, in theory, a portfolio should be constructed with the strategy in mind rather than an asset. Huh? Okay, that's the whole idea of a portfolio. Now, the strategy can be something as simple as, a retirement portfolio. So then the strategy is about adjusting the risk. That's a classic, right? Adjusting the risk as you near retirement, and then you move out of it. So you decrease the percentage of equity holding and increase percentage of bond holding. That sort of thing. That's completely standard, completely vanilla in the industry. Probably makes sense in my opinion. Although, as always, the devil is in the details. Fees are an important quote unquote detail and actually can literally kill your portfolio. So that's one. Also, um, you may not have the level of risk you think depending on the bonds that the portfolio manager is holding, that sort of thing. But I mean, overall, that's an example of well understood strategy in portfolio investing. Yeah. So you
Mhm.
manage your risk and you decrease the risk as retirement age approaches, right? Now, of course, there are all sorts of strategies that are marketed and that may or may not make sense. And there are actually good studies about that. And for example, because a lot of the problem with the strategy, for example, in the market, if you go to mutual funds, right? Typically, mutual funds um, are a good usually the punchline for buy side quants because they tend to oversell their product, right? So for example, they would say we have the perfect growth portfolio, right? And then you
Mhm.
realize that sure, in the back test it looks great because effectively it bought Apple 20 years ago and some other Nvidia and 10 years ago, something like that. And it looks great, but then what about the future? Yeah. And then 5 years later, it underperforms, like equal weighted portfolio, and everybody laughs. And then the mutual fund laughs all the way to the bank because they sold their particular portfolio strategy and collected fees and so on. So it's a never-ending sort of uh, sort of carousel of marketing and studies and so on. Now, as a quant, I'm going to kind of state the obvious, but I think it needs to be stated is that a strategy that is backtested is probably not going to work because there's so many opportunities to overfit your backtest that it's probably not doing what you think it's doing. I mean, unless you have a very, very clear investment theme that you want to promote, I mean, and it has to be literally about a particular sector, in which case you effectively long the ETF of that sector, or that sector compared to another and things like that. If it's that simple, maybe. But if it's anything more than that, it's probably going to be a marketing ploy and not a bona fide portfolio strategy. So one has to be careful, and that's why portfolio construction is such a difficult art. I would say that should really be science. But and I would add the following. I would add that it's become, especially with AI, you have products nowadays that can allow anyone without any coding experience or financial experience to backtest a portfolio with all sorts of fancy bells and whistles. And so anyone can go to these products and effectively have a sort of overinflated sense of what their results could be if they followed a particular strategy, right? Because it looked good in the past. So that makes me kind of uneasy because people are going to start managing 401ks that way.
Mhm.
And then,
You
and
know,
then we'll end up with the mother of all bubbles and that sort of thing.
yeah, that will explode in a certain time if people
Yeah,
will take that path. But
yeah,
I No, it's interesting because you have mentioned that petrol construction is not much more of a science, but it is a scientific problem, and I think that making a continuous portfolio construction process is where the scientific approach should come in. I think that everything that we have discussed during the discussion, if it's like causality and make causality interpretable with financial factors, going to correlation and understanding correlation and how the portfolio or a pair of assets within that portfolio actually deviates from each other. That will all, contributes, I think, to in a matter or in a fact to build a continuous pipeline for constructing in real time the portfolio. And I would like to ask you, Jerome, um, about thinking and about critical thinking processes, because I think it's very interesting to think about how to construct a proper trading strategy, but not in a way to think about the asset, or not in a way to think about how you're going to be approaching the problem scientifically. But I would like to talk about the development and to talk about the tech stack that you need to acknowledge in a way
sure.
to build that trading strategy.
The tech stack, yeah. Yes. Well, we have a lot of new tools at our disposal nowadays, and talking from experience, nowadays it's not only not inconceivable and entirely possible for like for single traders to have to build their tools using AI. I mean, I'm just like everyone, I guess, in the quant space. I'm a big fan of Claude and other AIs. So you can in many ways build your own stack. Now, having said that, if we're talking about a more sort of institutional framework, uh, there's always going to be a need um, for database developers and that will ensure that the data function of the firm is taken care of in a professional way. And because the more there's an explosion in particular not only in terms of financial data, but also of alternative data that people are more and more interested in looking at. So you need to have the proper level of experience in handling, so-called data lakes or a proper data infrastructure. Because I think the successful financial firms of the future will have to be at par with the best of the tech sector, the Googles of the world, in terms of managing their data. So that's
Mhm.
first and foremost. And so the data function has to be front and center in any firms. And some firms understood it quite early. I mean, certainly on the bank side, Goldman Sachs was famous for developing the in-house databases and so on. even their own language and so on. But yeah, that's key. Now, in terms of code, there's a big question mark, quite frankly, right? Because we know that a lot of these jobs are going to be replaced by AI. We don't know exactly how or to what extent. Uh, but I can't make a prediction on that, of course. But what I can say is that whatever happens will happen in finance first, because that's always been the case. Uh, because of the financial rewards of getting it right, you can bet that whatever gains of productivity there will be or is already in terms of replacing people with AI is going to happen in finance first. I would say in tech and
Mhm.
finance, of course, because obviously tech is leading, but it's kind of self-referential in a way. Um, so that's the question mark. But in any case, it means that the tech stack is going to be probably mostly AI based, with therefore a huge need for very very narrow and precise expertise in various fields of tech. So you're gonna
Mhm.
have these like super duper experts, and I'm lucky to know quite a few of them, I think, um, who know extremely well how you should, build a high frequency trading system or whatever trading system, and everything else is going to be gone.
Mhm. Yeah, well, that's I think, nowadays with the tools they have, obviously you are much more able to construct and to think about building the trading strategy from end to end. And I think it much easier to think about it because, you have a lot of, open source, like, that you can retrieve ideas from, and you can balance your idea or your software with the certain intersection with the open source from big quantitative hedge funds that you can look for and find out there. There is an abundance of data and abundance of open source, and I really think that it is much more interesting to think about trading ideas or developing your own trading system or your own trading language with the tools that you have nowadays. And I think that it actually forces you to think in a very different way. Fix me if I'm wrong, because you have a lot of things and a lot of things that will not be useful. So it actually forces you to think more critically about how to tackle it the right way, which is a task by itself.
Yep. No, definitely. And it basically,
Do
I'm sorry.
do you have certain suggestions for uh
Yeah,
for
no,
for building
I'm,
for building something?
yeah, well, I would say this. I mean, it's just like, it's really where capitalism shines. And to me, AI is the ultimate climb in the value added chain. So in other words, you have tools that can make you incredibly productive. I mean, in the right hands, it will make people incredibly. It's already happening, obviously, make people incredibly productive. And where it took, I mean, for me, let's say at Citadel 20 years ago, where it took us like maybe 3 months or 6 months or whatever it was to get data and test the strategy and so on, it can take a day, something like that. So in the right hands, it is a blessing. In the wrong hands, it can be a disaster. Obviously. um, just like everything. So I think people will learn to use these tools, and also to your point, to explore hitherto very hard places that we didn't have time, we didn't have the resources to explore.
Hmm.
I would say so it's true in finance, so it means we're gonna look at very weird data sets or very sort of alternative data like um, it's also happening throughout the economy. I mean, it's going to be. I think for the general public now, of course, this is a quant podcast, but for the general public, things will be even more dramatic for um, like other sectors of the economy because they will not recognize what's going on, I think.
Absolutely. Absolutely. And I look, I really want to say that I appreciate the conversation, but because I think that we have spoken a lot about, like, different topics, and we have dived into each and every single one of the topics in a way that, really forced me to think about my approach to things, and I really want to say thank you for it. Um,
Thank
and
you.
for the last question that I would like to talk with you about is emerging markets. Well, it's a very long and very detailed conversation, but emerging markets, it is a thing that you have always been fascinating, because you started and you saw how emerging markets getting to be established markets. And I would like to ask you, in those days, emerging markets are constructing in a different way than it was constructed back then, and still they have the certain fundamental rules, or the rule sets of an emerging market. And I would like to ask you, how would you tackle an emerging markets as a quantitative researcher? Because that's a question that I was receiving from one of the listeners, and I thought to myself that, hey, it is a great angle to for the conversation I have with you, and I would love to tackle that one.
Yep. And just to clarify, by emerging market, you mean, I suppose you mean a new market that sort of emerges, right?
New market,
Yeah, not
correct?
emerging market in the traditional financial sense, right?
No, no, no,
Meaning,
new
okay, yeah,
market.
a new market, yeah.
Yeah.
Okay, sure. Yeah, well, I can speak to that definitely because over the past couple of years, I switched to crypto, the crypto market. And crypto has been around for, and depending on how you count, but it's been around for real, I would say, for about 10 years, 10, 20 years, give or take. So it is, I would still count it as an emerging market in that sense. And it's definitely becoming more institutional, but it's still very much the beginnings and the early days. And so to me, it's fascinating um, how people try to solve problems in a completely new way, and how that created its own sets of other issues, of course. But so, for example, if you look at the so-called perpetual futures, I think that's a very nice way of solving the a lot of issues we have on traditional futures market. Obviously, there's a lot of things that are quite fascinating in crypto. And since it's a new market, it kind of leapfrogged. Right? That's a typical phenomenon, right? If something is new, you're not gonna apply the old idea. You just leapfrog to the front of the queue and then apply the newest ideas. And that definitely happened in crypto. So I'm expecting that for other markets. What's hot right now is prediction markets, right?
Hmm.
Websites, a lot of quant effort, and I predict that just like crypto, prediction markets are going to be quantified, so to speak. Uh,
They're already quantified.
there are in ways,
I
yes,
spoke to a hedge fund manager, by the way,
yeah,
offline, and he told me that they built an entire approach to tackle a certain news release
absolutely, absolutely.
from prediction market.
Exactly,
and they
exactly.
and they have constructed their entire risk management on top of it.
Absolutely. And it goes very quickly and now it doesn't take years. It's really much faster than that. And all the the very smart prop shop and hedge fund moving early, all the Jane Streets of the world, the Citadels of the world, and so on. They move into these new markets and they apply the quant method, which is to say the scientific method, right? Very thoroughly and very quickly, and they reap enormous gains. So that's what I see for pretty much any emerging markets. Now, of course, there are things that are more amenable to these kind of methods. One thing of interest to me is the art market because it's still not disrupted in many ways. I mean, um, right, understanding valuation in the art market, for example, that's fascinating. Can you do quant in the art, modern art, let's say, market? That's still a question mark, very much an open problem. I think it's fascinating. The answer is probably yes, but who knows?
Mhm.
I definitely know people who are working on that. Some hedge funds have tried it, some failed, some have limited success,
Mhm.
and you can go down the list. I mean, um,
Yeah, and by the way, there is a pattern that I really like. The big ones like Citadel, Jane Street, and so on, they're the big ones that controls the market. Like
yeah,
there's not controversial thought about it. And they are the faster adopters of the field as well. So it
yeah,
actually symbolizes thing about the quantitative industry as it is, because you do not expect from big institutions like, I don't know, big companies from other industry to adopt fast as like Citadel or Janstreet adopts in their own industry. And I think that's fascinating because you actually see how the financial sector entirely is actually getting constructed with the help of the biggest that actually mandate mandate the industry entirely. So
yeah. No,
that's very interesting to see that.
absolutely, absolutely, and I think the sort of the quant method, AI, um, are it's a cliche to say it's the third industrial revolution, right? Second one being internet. I think it's true. I think it's happening. It's happening in all sectors. But as always, it happens in finance first, right? Because
Hmm.
that's what capitalism does. It takes care of the core first and then the periphery. And I think that's an exciting time to work in finance right now.
Hmm. Absolutely. Okay, Jerome. Thank you. I really appreciate your participation. I really enjoyed the conversation. I thought
Thanks
it
for me.
was. I think it was extremely fruitful to think about the direction that you're taking in the financial markets too. Yeah, I really like that. Really like that.
Excellent. Well, thank you very much indeed for the nice conversation.
Thank you, everybody, and see you in the next time on our show with the Blushing Quants. Bye, everybody.